All right, so let's talk about these ordinary assets here first. Having a rave next door. So when an asset is sold or otherwise disposed of, we have that gain or loss. It's considered either ordinary or capital. If it's ordinary, it's going to be taxed at ordinary tax rates. If it's capital, it's going to be taxed at capital gains tax rates. Okay, we've already talked a little about some of those tax rates when we talked about the qualified dividend income. Remember we had those special tax rates for qualified dividends. We had 0%, 15%, 20%. That's going to come back. Those are some of the capital gains tax rates. There are a couple of other special tax rates as well that we're going to add to that. But that's essentially what it means. If it's ordinary income, it's taxed at ordinary tax rates. So those marginal tax rates that we started out with was 12%, I can't even remember them off the top of my head, 22%, 24%. They've changed them over the last couple of years. So it's a little bit harder to remember. You know, up to 37%. Those tax rates are our ordinary tax rates. Capital gains tax rates, capital tax rates are different tax rates. So when an ordinary asset is sold, it is termed an ordinary gain or loss. When a capital asset is sold, then it's termed a capital gain or loss. When a 1231 asset is sold, that third category, the long-term trade or business assets, it may be ordinary or it may be capital. Okay, so everything we're talking about up here is just going to be ordinary. The second category, it's all going to be capital. The third category, it depends. So we'll deal with that when we get to the third category, those long-term capital gains or losses. Capital gains, again, are taxed at, and they say lower capital gains tax rates, not always lower, but usually it is lower, compared to ordinary gains that are taxed at ordinary tax rates. So it's usually preferred to be able to sell something at those capital gains tax rates because usually you're going to pay a little bit less in taxes. Capital losses, now that's just the gains. They'll be taxed at particular tax rates, but we also have losses that we have to deal with. Sometimes we sell assets at a loss. Capital assets have special loss rules. They have a lot of special rules that go along with them. Actually, by the way, the capital assets, they're limited in their deductibility. Only a certain amount of capital losses can be deducted against other income, whereas ordinary losses, for the most part, are deductible in full against other income. So that's one of the differences. Also, how we net capital gains and losses has some unique features to it. All right. So recognize gain from ordinary assets. So the primary ordinary income assets are inventory and accounts receivable. Inventory sold in the normal course of a trade or business generates sales revenue. The cost of that inventory is a deduction as a cost of goods sold, right? The type of transaction that we're talking about are the sales of ordinary assets outside of the normal course of business. We already talked about sales in the last chapter in the ordinary course of business, right? That's what we did on our Schedule C. Here we're talking about sales of ordinary assets that are outside of the course of normal business. And typically these are ordinary gains or losses produced outside the normal course of business relate to the sale of business property that's held less than 1 year or the sale of accounts receivable. So some examples here. Sheetal, sole proprietor, needs cash, short on cash, decides to sell some outstanding accounts receivable. So that example that I gave you earlier, they've got accumulated accounts receivable from clients. They don't want to have to wait for the clients to pay. So they're going to just sell all of the accounts receivable to maybe a collection agency. So they have a $10,000 fair market value. So all of the accounts receivable together, the amount that's owed is $10,000. They have a zero basis. Obviously, there was nothing put into them. They have no basis. They can sell the receivables for $8,500. What's going to happen there? They're going to recognize an $8,500 gain on that sale because they received $8,500 and there's no basis to those. If they were to just collect the accounts receivable, not sell them to a collection agency, but just collect them in the course of business, they would be paying tax at an ordinary rate for those receivables. Now, they gave up $1,500 in exchange for getting that money now. So they're going to have to recognize an $8,500 gain because they have no basis in it. Sheetal sold some equipment for $22,000 on March 7th, 2024. It was originally purchased for $24,000 on April 3rd, 2023. Short term, right? Hasn't been a year yet. They have not owned it for a year. They bought it April one year, sold it March the next year. The equipment had depreciation of $8,640. So they took $8,640 of depreciation for both 2023 and 2024, meaning that the adjusted basis of that equipment is $15,360. The cost minus the depreciation that had been taken. So they recognize a $6,640 ordinary gain because it was owned for less than 1 year. It's an ordinary gain. So which is $22,000 minus the adjusted basis of $15,360. This is what it looks like on the form. The 4797. So here's the 4797, sales of business property. Here. First section, sales or exchanges of property used in a trade or business, and involuntary conversions. So something that they didn't sell it of their own free will. It was maybe taken from them. From other than casualty or theft, most property held for more than 1 year. So this first part is for more than 1 year. In our examples up here, it was less than 1 year. So we're not going to use this first part 1 section. We're going to use part 2. Ordinary gains and losses. So this includes property held for 1 year or less. So there's that 1 year or less that not less than 1 year, but 1 year or less. So if it's exactly 1 year, it's short term. Has to be 1 year and 1 day to be long term. So here's the example. There's that accounts receivable, which would have been, let's see, the date acquired, date sold, sale price, depreciation. So this is various, but it's still short term. Various date sold. Sold for $8,500 has no basis because it's inventory. I'm sorry, because it's an accounts receivable. So what is this one? Cost or other. So we didn't take any depreciation because it was accounts receivable. That's not a depreciable asset. And then 0 for the cost. So we have an $8,500 gain. That equipment that was described up above, was purchased or sold on April 8th, 2020. That should be 2024. So April 8th, 2024. No, I'm sorry, that's when it was purchased. April 8th, 2023. Sold, this should be 2024. May 7th, 2024. So they forgot to change that in the book. The sold for, or purchased, I'm getting these mixed up. Sales price was $22,000. They had taken depreciation of $8,640. They received $24,000 for it. So sales price. So their cost, what they paid for it was $24,000. So the gain on it was $6,640. So both of these are going to be taxed at ordinary tax rates, these amounts. So here, combine it all, line 17, $15,140. And the total, redetermine the gain or losses, excluding the loss, if any. Enter here, and on Schedule 1, Part 1, line 4. So this is going to go then transfer to the Schedule 1 under other income. and then gets transferred ultimately to the 1040 under that other income line. Okay? So when does the holding period start? This is kind of important information. When does the holding period start? Because it's important to determine whether we've held it for a year or more, or whether we've held it for, a year or less, or more than a year. So when does it start? When does that year start? If it's a stock or a bond, it starts the day after the trading day that the taxpayer purchased the security. So if I go and buy a share of, Tesla today, my holding period for that stock is going to start tomorrow, the day after. So it would start October 15th, day after the trading day that the taxpayer purchased the security. If it's a non-taxable exchange, the day after the taxpayer acquired the old property. If it's a gift, the taxpayer's basis is the donor's basis, and the holding period includes the donor's holding period. So Grandpa gave me that land instead of inheriting it. That means that I'm going to get his basis, but I'm also going to get his holding period. So if he bought it back in 1970, it's considered that that's when I bought it. That's my holding period and when it would start. If the taxpayer's basis is the fair market value, the holding period starts the day after the date of the gift. Inherited, the holding period is always considered to be held more than 1 year. So you always get long-term. It's always, let's just say Grandpa bought that piece of land the day before he died. He died on October 1st, and I inherited it on October 2nd. And then I turn around and I sell it on October 3rd. Well, because I inherited it, I get to treat it as though he held it for more than 1 year. So I get long-term treatment on that, okay? Property is considered held longer than 1 year regardless of how long it was actually held. Real estate purchase the day after the taxpayer received title to the property, so whenever the day after the closing date, real property repossessed, date the taxpayer originally received title of the property, but not including the time between the original sale and date of repossession. We don't have any examples of that in any of our problems. All right. That's ordinary assets. Okay. Again, short term, a year or less, used in a trade or business. So this would not be stocks or bonds or things like that. Inventory, accounts receivable, notes receivable. If it's and these are, again, sold outside the regular course of business, it's going to be reported on a 4797. If it's just part of the regular course of business, like a piece of inventory, then it's going to be reported on our Schedule C, and it's going to be reported under the cost of goods sold section of that Schedule C. Okay? Otherwise, it'll go, where is it? Come on. Otherwise, it's going to go here, Part 2 of the 4797.